Welcome back to What Are Your Thoughts? It's me, Downtown Josh Brown. I'm here with Michael Batnick, a summer edition of What Are Your Thoughts, our favorite game. I don't know what Mike wants to ask me about. He doesn't know what I want to ask him about.
I have some ideas.
You have some guesses? All right, well, I guess
I
we'll
have some
see.
ideas.
I guess we'll see. Stick around. Okay, so I'm going to go first. I want to talk to you about something that I heard you and Ben talking about on your podcast, and I think you've written about bubble behavior during a recession or a crash. And you guys seem surprised that we had all these like mini speculative bubbles in the stock market, but I wasn't surprised because I always see this stuff in recessions and bear markets because I think it brings people out that love volatility. Why were you guys so surprised to see things like Chesapeake and Hertz and all of the Robinhood stocks? Like, why was that so surprising to you guys?
Why are you surprised that we were surprised?
I don't know. You've seen bear markets before. Like, you're not 22 years old. This is I don't know. I remember in the 2008, 2009 bear market, the most actively traded stocks were not even stocks. They were triple leveraged ETFs. Like
FAZ.
FAZ, TNA. Remember TNA?
TZ, and TZA.
Right. So there were people betting on triple leveraged versions of the VIX, small caps, bank stocks. Those were always in the most active column. And that was going on in 2009 when we were really at the bottom of the economy and people betting both. I just think volatility brings out gambling, not levels of the stock market.
Yeah, okay, fair. Volatility absolutely brings out gambling, but last time, and like no other time, actually, I should say, we never had a quarantine like this. We never had free commissions. You never had Portnoy, like a Portnoy-like figure leading the charge, Wall Street bets. You never had all these things. So it was the perfect setup for this type of mania that we're seeing. And it is weird to see bubble behavior in a recession. It just is.
I just don't think so. I think separate the recession from the bear market. I think there are always pockets of bubbles even in bear markets because people are betting on even volatility. I don't know. I think it just brings out speculators. Here's what made it maybe exacerbated at this time. Obviously, no sports, and it's the only game in town. So I think like there's an element.
I think more than that is the lockdown and people not having anything to do.
Yeah, that's a good point. So right, so it's two things. It's nothing to bet on and nothing else to do, and the markets are.
So let me ask you a question. Do you think that there's any sort of signal here in terms of like a Portnoy top or anything like that?
I think there's like an anecdotal signal, just with trading volumes in certain stocks, and like maybe the Hertz Chesapeake thing from last week represents the apex of that. So basically, like people betting on the equities of companies that have already filed for bankruptcy, and having those stocks go up 100, 200, 300%. Like that to me, I don't know if there's any data. I don't think we've ever seen anything like that. So I would say like it's an anecdotal top for the speculative part of the market, but maybe not for the whole market.
But how about this? People are like, oh, what are they going to do when the airlines stop working or the bankruptcy stocks stop working? Then they'll trade VIX products or what they're going to do. Whatever's working, they'll trade.
I think that's my point. If you're looking for action, you will find it. It'll exist somewhere. And then everyone will say this is a new bubble.
Let's move on from the young traders to the older investors. An article just came out in the Wall Street Journal. Data
is it about me?
Data from Fidelity. Nearly a third of investors who are above the age of 65 dumped all of their stock sometime between February and May.
How many? A third?
A third. And if they look at all of their investors, 18%.
That's rational, because what if that third actually are living on that money and pulling that money out? They can't afford as much volatility as someone who's not living on the money.
Rational, but correct? What are you saying?
No, I'm not saying it's correct. I'm saying if you are actively...
Are you saying it's understandable? Yeah, of course it's understandable.
Yeah. Well, no, it's beyond just rational. We don't know the financial circumstances of that third of the people that pulled all their money out of stocks. How about fine, forget about that. How about 18% of everybody? 18% sold all of their stocks
All.
That's
Now
that's
it's
wild.
impossible. There's no real great answer here. But what do you say to somebody now? Or what does somebody do now
Hold on a
after
second.
they sold?
Hold on a second. 18% of all Fidelity retail accounts or a specific type of account?
All Fidelity
Okay.
retail
So Fidelity
accounts.
is the largest brokerage firm in the country. So they are a $7 trillion firm. So let's say they are the most accurate representation of what investors are doing, right? Maybe like them and Schwab, even more so than Vanguard, right? So
Yeah.
we're saying that a fifth of investors cashed out of the stock market. That's
Yes.
I would never have guessed it was that high. During what months?
Now it says from February 20th to May 15th. So I'm sure that of that 18%, whatever, a portion of them sold after the rebound. A portion of them saw stocks rise so
Yeah,
much.
they didn't
Like,
all sell the low, right?
correct. Yeah,
Okay.
exactly. I think
Well,
that's an easy conclusion to draw, but that's not necessary. We don't have data there.
all right.
When they sold.
Here's what I'm going to tell you. The 1/3 of people over 65 is very understandable because within that group, there are people who are probably trying to save a business. Within that group, there are people who are maybe taking 4% or 5% out of that capital each year to pay for their lifestyle. Like, if that's what you're doing, you can't tolerate a stock market that sells off 50%. If you're living on that money today, like it's obviously the type of behavior that's indicative of people that need the money for the most part. I don't think all
Hold on.
sold just because they were scared.
But a big portion of that them certainly sold because they were scared. Because let's say that you're 65 to 69.
Yeah.
What percentage of stocks do you think are in your portfolio anyway? It's not like these
You're
people,
probably under 50%.
and I have no data here. Yeah.
Yeah.
So if you went from 40% stocks down to zero, that's not rational.
Well,
That's fear.
that's why God sent financial advisors into the world. Is as Nick Murray would say. So those are people that are either
By the way, that quote's a bit.
It's a little much. Whatever.
It's a little much.
Nick's my guy. I think if you had a financial advisor, you probably didn't cash out all your stocks. And if you didn't, it doesn't mean you did cash out all your stocks. But if you did, maybe you would benefit from having like somebody to bounce things off of. And if you're on like one of these email advisory platforms at a place like Fidelity or whatever, but you're somebody that's prone to panic, it might not be the best fit for you. You might be better off with a person to talk to, because I think most investors who actually had someone to talk to probably didn't. I'm just making this up, but this is my guess based on knowing people and seeing this before. If you had a second voice in your ear besides your own voice and someone who's a little bit more emotionally detached, you probably didn't cash out all your stocks. So that's why I make that comment.
What percentage of people who cashed out, let's say on the way down,
Yeah,
are able to wipe the slate clean and come back into the market with, objectively,
None.
without any baggage?
None. Until time has to pass. If you let's say you sold last week of March, first week of April, which was totally understandable. Like if you took yourself to zero and you said, I'll get back in when things calm down. Well, things calm down and the market's 40% higher. A 40% bounce off that low rather. So like now you can recognize things are more calm, but you can also recognize that you're going to be buying back in much higher. And it's really, really hard to do that. Like
I think it's almost impossible.
like I would have trouble doing that. So I think this is what separates rules-based investing and a strategy planned in advance from somebody who just like makes moves based on how they're feeling. So, and just because you're rules-based doesn't mean all your buys and sells are going to look good, but there's a rule that's determining what you'll do in advance. If you're just like, I really feel like I should be in cash, then right now you're not saying, I feel like I should buy back in. You're saying, I feel like I should wait, and maybe you'll get another chance. It's hard.
I think the mentality is probably like, I'll get in the market, I'll get back in, and just my luck, it'll go down again. And so let's say that they do get back in. The first 3% down day, they're out. So let's say that you got back in last week and we had that really awful day. Stocks were down 6%.
Right.
You probably panicked out that day too, no? Because I think that
last week, the Dow down 1,800 points. You're like, I can't believe I just bought. Yeah,
You're gone. past behavior is the best indicator of future behavior. I think we all know that to be true. All right, what do you got?
So the last thing I'll say on that, Barry and I started working together in 2011, which was like 2 years removed from the bottom of the stock market. The first 3 years of us onboarding clients, I would say like 2/3 of them were people who were sitting in cash. Like they got out, some of them early, so they didn't get killed, or some of them lost a lot, but they were almost everybody was in cash still. And they needed somebody to do it for them. They couldn't bring themselves to buy back in. They needed someone to tell them, give me your money and I'll do it. And thank God, they found someone, whether it was us or another advisor. All right, here's what I want to ask you about. I'm like not, I don't dwell on all the Fed criticism. Like I'm not one of those people that buys into all the conspiracy theories. But I think in this moment, we are really seeing the Fed way overstep like its purpose, its bounds, and do things that like are just so far away from what we traditionally thought of as their mandate. I want to read you something Peter Bookvar put out this morning. And he's like a Fed critic, kind of like a, let's have less regulation and we'll need less intervention kind of guy, but he's reasonable. He's talking about the Fed buying investment grade bonds. They're literally buying LQD directly, which is what they're doing right now, which is wild, by the way. So he's saying the Fed is directly making investments in Apple and Microsoft bonds by doing that. The LQD, the index backing it, and what the Fed is buying, they're buying Anheuser-Busch, Goldman Sachs, CVS, Wells Fargo, Verizon, Visa, Comcast, and Berkshire Hathaway. Why do we need the Fed doing that? Like it's some sort of an emergency. Like in what way is that facilitating anything right now?
So they were buying $300 million worth a day of bond ETFs.
Yeah, why do we need that?
And now they're creating like a custom index or a broad-based index, I should say, where they're going to be buying bonds directly
through BlackRock.
But they're going to be buying outstanding bonds.
Yeah.
So I almost would more understand if they were buying direct from the companies where they were like, okay, we need to provide direct liquidity. But in the secondary market,
the companies the companies that are investment grade don't need capital directly from the Fed. That's what the definition of investment grade.
But but they're also buying companies who lost their investment grade status as a result of this.
Right. So Peter's basically saying JP Morgan can take treasuries on its balance sheet, put them up as collateral, and buy some of these bonds out there that are yielding 7-8%. Like the banks should be doing that, but we regulated them out of that business. And that's why it falls on the Fed to rescue fallen angels. But then going a step higher, what is the transmission mechanism by which the Fed buys Apple bonds right now? Like in what way does that facilitate anything in the real economy?
Well, I guess by doing that, they don't want to discriminate and be like an active market participant where they say, okay, we're going to buy Caterpillar, but we're not going to buy Honeywell. We're going to buy Microsoft. We're not going to buy Apple. So I understand.
That argument is lost on me. I don't know. I don't get it.
You want them to be like acting like Gumlock out there? I mean, let me ask you this.
What if they had rules? What if they only bought the bonds of companies whose debt payments are higher than their cash flows, which are the definition of fallen angels? So like these are companies that actually need it.
Reasonable. What is the downside?
The downside is market distortion, people not trusting the system.
Too late.
Asset price inflation. Like we can go on and on and on. I know, too late. All right, what do you got?
This is a big question. I'm not really sure what I'm looking for as an answer, but what are some of the lessons? Like what did we learn with the fastest bear market ever, the most ridiculous bounce ever? Like, are there any tangible takeaways, not so that we can be better prepared for the next time, but just broader investing lessons?
What did we learn as investors? It's
epidemiologists.
Well, I learned a lot more lessons about business than I did about investing this year. But what did we learn as investors? I think we relearned that nobody knows anything. Like you just had the fastest bear market in history. It took 20-something days for the stock market to lose a third of its value, which has never happened in history before. Absolutely nobody saw that coming. Absolutely no one. Okay. And then immediately following, you just had the best 50-day rally in history with a 39.6% gain for the S&P. Immediately following the fastest bear market ever. There are people writing commentary now saying, did we even have a bear market? Or was that just a panic? Like that's literally what people are saying because of how fast both halves of that took. So nobody saw really either one coming or for the reason they came. So what did we learn? That, quite frankly, you can read as much investment commentary as you want, and it'll educate you as far as what people are thinking, but you will never read anything that will prepare you for the real shit that goes on. And I think you have to get comfortable with that. That's why you earn 7% a year in stocks versus 4% a year in bonds, because you're taking that extra risk. And so you just have to learn to live with it. And if you can't, maybe investing isn't for you. I don't know. That's my takeaway. Why? What did you learn as an investor from this? Is there something tangible that you can take away from this that you didn't already know?
When the stock market goes down 21%, 35% in 21 days, the Fed will step in.
The Fed stepped in before it was even. I
don't. Yeah, I don't know. I guess. Yeah, I think you're right. It's just relearning lessons that
the Fed stepped in November. The Fed started doing QE in November
with the repo stuff.
Yeah, dude. What do you think that is? The Fed is buying assets in November already. We had Fed intervention in the bond and cash markets 3 months before the top of the market. It's endless. That's the point I was trying to make before. All right, whatever. I went to a restaurant for the first time, I guess since February, over the weekend.
Where'd you go?
A little weird. So we were on my friend's boat, and we stopped at an outdoor place on the water. We pulled the boat up to the dock. So we ate outside. The waitresses had masks. You had to wear a mask to go into the building to use the restroom, but you could sit at the table without one. And they brought plastic silverware, in individual packets. So a plastic knife and fork, but everything else was and drinks were out of plastic cups, but at this place they might be anyway. But everything else was totally normal, and it was nice. We left a huge tip. This poor girl is walking around with a mask on her face. It's 85 degrees out, but it was nice. We sat at the table for 2 hours. Nobody wanted to get up. I don't know. Have you been anywhere to eat?
No.
What's it going to take for you to go to a restaurant? Are you mentally there yet, or?
I just don't really feel like going.
Really? You don't miss sitting down with another family or another couple for a meal?
You guys do that a lot more than we do. We have to get a babysitter, you know what I mean? And we're not really letting anybody in the house yet. And okay. I really don't miss it. I have no desire to now where you were, that sounds great. You're on the beach, that's nice. But would I go and sit in the La Piazza parking lot? I don't want to do that.
So what, sidewalk tables though?
Yeah.
Nassau County lets all the restaurants do some tables outside, which they should have done years ago.
I mean, that doesn't interest me at all. So I'm not dying to go back to a restaurant.
Okay.
All right.
We missed it more than we thought we did. I guess what I'm saying. All right. What's up?
So I don't know what's going on, but I'm starting to wonder if I even like movies. I love going to the movie theater.
You like shitty movies. We know.
But maybe
you like Shark Attack movies. That's your thing.
I do love Deep Blue Sea. But maybe I'm just on a string of movies that I don't love. For example, these are the movies that I've seen recently. Did you see King of Staten Island?
No.
I thought it was
is that the kid from Saturday Night Live?
Yeah, Bill Burr was incredible. I thought it was a sweet story, but it was just boring and slow. I watched Perks of Being a Wallflower. You ever see that one?
The f*** are you watching that for?
And then I saw...
Where are you getting that?
I'm just
where are you getting that from?
Hold on. And I saw Bull Durham. I never saw Bull Durham. That's a classic, right?
All right. So I like Westerns. I like movies where it's good versus evil, or it's really murky. And I like movies set in a time and place where people had to be more independent and they had to save themselves. And
No, wait,
I
hold on.
like
So let me
morality tales.
let me just finish.
So that's what I would be. If I were you, I would just start watching like the best Westerns ever made.
No,
and
if
stop
you were-
watching
if you
the
were
perks
you-
of being a wallflower.
If you were you would watch those.
No, if I were you, I'm teaching you something that you don't
You're
know
not
about.
me.
Okay,
Is
true.
watching movies at home during this like changing how
Again,
it feels like homework almost.
Again, no, it's a function of what movie. You got to watch a movie that you can just get totally lost in. If you're watching a movie and you have your phone in your hand, you're not really
Right.
You're not really watching it. So
True.
I don't know. That's what I would say. All right, here's my last one. The App Store. So Apple very quietly became the first company in history to hit $1.5 trillion in market cap. I feel like there was a lot more fanfare when they hit $1 trillion, and then like very quickly they they added 50% more market cap during a pandemic, which is incredible. So they are saying today, there's a story at TechCrunch that the App Store ecosystem in total, meaning every mobile app on the Apple platform, facilitated $519 billion in billings and sales globally last year.
Holy cow.
Think about how big that number is. And then the $1.5 trillion market cap doesn't sound as ludicrous. That's $500 billion in commerce. So that's everything from people booking an Uber to people ordering groceries from the Target app.
So let me ask,
and everything in between.
what so that money, 519 billion is a lot of money. Where was that money being spent prior to the App Store?
Physical Walmart, physical Costco, physical supermarket, taxi cabs, paying people cash, like get in a cab, take me to the airport, here's $30 cash, like that. All right, so they're saying, listen to this. The study notes that because Apple only receives commissions from the billings associated with digital goods and services, so in other words, they don't get a piece of e-commerce. If you're on the Target app and you spend $200, Apple doesn't get anything from that. But they do get a piece of services and digital goods.
For example,
so they're saying more than 85% of the 519 billion total accrues solely to third-party developers and businesses. So they're getting a commission on some stuff, but not all. Out of that 520 billion, 268 billion of it was retail. And a lot of that includes traditional brick and mortar retailers. So, a lot of stuff is getting thrown in there, but they're saying ride-hailing apps like Uber and Lyft were 40 billion in sales. 40 billion. Just on. So what Apple has built basically is like a layer on top of the global economy, and they're getting a commission on some and not on other, but they're facilitating $500 billion in commerce every year. Then you can start to rationalize why this company is worth $1.5 trillion.
Looks cheap.
Because it's on that metric, it's cheap. All right, that's all I got. Let us know what your thoughts are on the topics below. Mike and I love to hear your feedback. We love when you guys play along. We're always interested in your comments and suggestions. Go ahead and smash that like button for us. Subscribe to the channel if you have not already, and we will be back very soon.